A big miss on non-farm payrolls, but we're not seeing a big drop in futures. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, job jitters. U.S. hiring remained tepid in August, even as the unemployment rate ticked lower.
And now everyone is placing Fed bets. Billionaire John Paulson says the central bank has waited too long to cut rates.
We'll discuss all that and more with our all-star lineup of guests, including acting Labor Secretary Julie Su, BlackRock's Rick Rieder, and PIMCO's Tiffany. Let's take a look at where markets are trading 30 minutes until those bells ring. You have a little bit of a gain on the S&P 500 pre-market. We had been lower, now peaking higher after that jobs report. It did miss, but maybe not enough to indicate that the economy is falling off a cliff. That could explain some of the action here. The Nasdaq 100 still lower, and the bond market a little bit of a rally, Matt. The 10-year Treasury yield currently down about 3 basis points.
All right, the whisper number was lower than the 165 we expected in the survey. Here you can see non-farm payrolls growth. I will note that Mark Zandi told Tom Keene and Paul Sweeney on Bloomberg Surveillance just moments ago, you invariably see revisions higher from this August number because so many people don't report being on vacation in August.
Before we get back to the macro, we are going to talk about some pre-market movers on our radar. Broadcom shares falling, but not because of AI sales. It's actually because of the non-AI side of the business appears to be slowing in growth. Broadcom now down pre-market 6.2%. U.S. Steel, though, on the rise about 3.1%. Moving on news from its rival, Cleveland Cliffs, whose CEO expressed interest in the company if the Nippon deal falls through. A big switch up in sentiment there. And sources say Intel is considering a sale of part of its 88% stake in Mobileye, and you have Mobileye down 3.5% pre-market, Matt.
All right, let's talk about U.S. hiring. Obviously, it's been the focus. We've been waiting for this jobs number all week long. It fell short in terms of the number we got for August after downward revisions to the prior 2 months as well. We get more details with Michael McKee. He's our chief international economics and policy correspondent. So this is it. We waited all week for it, and really all month.
It's kind of a damp squib for people on trading desks because you're in the middle. You get good news on the unemployment rate. You get bad news or semi-bad news on job creation. Job creation, as you mentioned, just 142,000, and the revisions were important, minus 86,000. Last month, only 89,000 jobs created. The unemployment rate, though, falls to 4.2%, rounded out to 3 places, and you can see why, a significant drop from the prior month. Participation rate unchanged. Now, here's what happened with unemployment. The labor force did not expand as it has been. Household employment rose. The household survey unemployment fell. And so all of that combines to bring the unemployment rate down. Hours worked went up 34.3, which tells you that the economy is not falling off a cliff. Companies just aren't hiring. Same story we got in the Beige Book. We have had one Fed official, John Williams, the New York Fed president, vice president of the Open Market Committee, out this morning saying, with the economy now in equipoise, that was his word, and inflation on a path to 2%, it is now appropriate to dial down the degree of restrictiveness in the stance of policy by reducing the target range for the federal funds rate. He didn't say by how much. Maybe we'll get that from him as his comments go on. But now he is on board with a rate cut next week.
All right, Mike McKee, thank you for that, of course. You take a look at how markets are reacting, guys. Again, a little bit of a rally in the S&P 500. You could call it unchanged, though.
And big changes in expectations here for what people expect out of that rate cut. Potentially more cards now on that jumbo cut. And, of course, the 2-year real yield really plunging here, about 5 basis points this morning.
Just dropping away. The floor is gone from the 2-year yield.
Yeah, it certainly has. Well, we'll keep an eye on that and more as we welcome now our Bloomberg TV and radio audiences. To parse this report, I'm pleased to say we welcome Acting Labor Secretary Julie Su. And let's just go through some of the numbers here. I know you're well aware of what happened at 8:30, but the unemployment rate, it actually edged down to 4.2%. That was its first decline in 5 months. Payrolls only rose by 142,000 jobs. That leaves the 3-month average at the lowest since mid-2020. So jobs growth, and it is growth, it's weakening. Is that a concern for the administration 2 months away from the election?
Hi, it's good to be here with you. I would say that this is another job report that indicates that we are continuing to see stable growth. Job numbers are still up. The unemployment rate ticked down slightly. As you've already mentioned, labor force participation remains steady. Earnings are up. This is a continued sort of the, steady transition, to an economy in which we're continuing to see people come into labor market and find jobs, and it's a transition to more stability.
And I know that you're not going to opine on what the Fed should do from here, but of course the concern is out there that we could see this weakening turn into a real deterioration if we don't see the Fed lower interest rates from here. The current policy rate, do you think that that's out of step with the economic reality in the labor market?
No, and you're right. We don't comment on what the Fed will do. But again, I think overall, this is another month of many months in which I've come here and we've talked about how we continue to see job growth, right? The numbers are still up. We're continuing to see growth in various industries. We see construction, healthcare, leisure and hospitality, right? These are all signs of an economy reaching a normal, steady, stable state, and we, want to continue to create the investments that are leading to this kind of job creation. And the president will be traveling to Michigan later today to announce an executive order that is ensuring that we're not just counting the number of jobs, we're also making sure that these jobs are good jobs where families can get ahead, where people can make a steady income, where they can retire with dignity. And so these are all part of the economy that the president promised when he came to office, and the economy that these numbers reflect.
Well, building on that, Julie, let's take a look at the specifics at the sector level, because you take a look at the manufacturing industry. It lost 24,000 jobs. The estimate had been for a reduction of 2,000 jobs. And actually, the last 3 of 4 reports, I believe, that sector has shed jobs. So what's the current view on why employment in manufacturing has been weakening?
So I would say cumulatively, again, the number of manufacturing jobs created since the Biden-Harris administration began is over 700,000 jobs. This is also part of the promise that we will make things in America again, from semiconductors to electric vehicle batteries. The idea is that American workers are the best in the world, and they can and should be making things. The investments that are going into communities are also, using American-made steel by American union workers and raw materials mined by American union workers. And so, the job growth that we have seen, which again was not promised, most people predicted that it would not happen the way that it has, is not happening by accident. It's happening because of real investments and a commitment to job growth. So when you look at the overall trends, manufacturing has gone up since the president came to office. Construction had significant growth over this last month, and that is also no accident.
And I also want to get your perspective, of course, on some snafus, if you want to call them that have happened at the Bureau of Labor Statistics when it comes to data releases, because there have been a lot of questions about fair access and distribution of economic data following, of course, the February super users incident. We had the early release of inflation data in May, and then last month there was that delay to the payroll revisions figures last month. What steps is the BLS explicitly taking to address those missteps?
So the BLS has addressed those head on. We obviously believe in transparent and timely release of data to everybody. That is why I come on. That is why we release the data each month the way that we do. And so the BLS has attacked those issues head on to ensure that they do not happen again. The fact that some of the information came out not in the way that we exactly would have liked in terms of their timing of release, certainly, though, doesn't take away from the fact that this data remains the gold standard for how we judge the health of our economy, how we look at job growth, the unemployment rate, and changes to industries when it comes to the labor market.
Well, Secretary, I'd love to get a little bit more detail on what that looks like, that head-on addressing. I mean, are you considering going back to lockups? Are you potentially firing people here or hiring more? What does that look like?
I mean, we've definitely put in place, to the extent that some of them were technical issues, right, addressing those issues. Again, we are absolutely committed to timely and uniform release of data. Each of these incidents were really, different, but we are taking a systematic look at how to make sure that they don't happen in the future.
And while I still have you, I asked about hiring specifically because I spoke to former Fed economist Claudia Sahm the day after that payroll revisions delay, and she made the point that the BLS is underfunded. And of course, our reporting and other news agencies have reported something similar. So I'll put that question to you. Does the BLS need a bigger budget?
I mean, certainly nobody wants to see all parts of the Department of Labor adequately funded for the important work that we do but I'll also say to that question about the Sahm rule and what it means, a lot of that is about looking at historical data to judge what is happening now. And I think what we've seen is that what's happened before isn't necessarily a good gauge for what is going on here today, right? The post-pandemic economic recovery, the historically low levels of unemployment for such a long period of time, and the investments that are being made that have really shaken up the job market in positive ways. And so overall, the many indicators are continuing to show that that the economy is growing and that the economy is strong. And either way, obviously, it's important for us to keep on reporting the facts as they come out.
Secretary, really appreciate you taking the time on what I know is a busy morning. Our big thanks, of course, to Acting Labor Secretary Julie Su. Meanwhile, let's turn this conversation back to the markets right now. Of course, the S&P 500 pretty much unchanged in pre-market trading. You take a look at the bond market right now. You have yields inching a little bit higher here. We have the perfect guest to unpack this all with, Rick Rieder. He is the CIO of Global Fixed Income over at BlackRock. He joins us now. Rick, great to see you again. You take a look at this market reaction. I know that you would have cut rates back in June, but you take a look at what the Fed is facing 2 weeks from today. Do you think that they should go 50?
Well, I've learned in my career to not invest based on what I would do. It's like you got to follow what they're going to do. And listen, I think they should go 50. Do I think they're going to go 50? I mean, we got an inflation report next week. I mean, that's going to be important. Listen, I think they're going to err on the side of doing 25s and stay down the fairway. I don't agree with it. I think the funds rate at 5 3/8. When you've got inflation running, we said we're going to get the data. But the last 3 months, you take the high frequency data, core CPI is running at under 2%, 1.6%. You strip out shelter, it's actually negative. And we know shelter's coming down. 5 3/8 is the wrong price. I think they should get there sooner. My sense is they're not in as much of a rush, and I don't think they learned that much today. You've got a slowly deteriorating labor market, but the slope of the line is just not that intense, and so. Should they go 50? I think they will do, or I think they should. Will they? I don't know.
Rick,
I don't know.
To that end,
I don't know.
To that end, I'm curious about how you see the market pricing adjusting here. If you look at WIRP on the terminal, you have more than 118 basis points worth of cuts priced in through the end of the year. Is the market overcorrecting?
Listen, I think it's aggressive. Yeah, I think it's too much. That being said, I know we've talked about it before over the last couple of months. I like owning yields in the front to the belly of the curve, but I think what has happened is the front of the curve, exactly what you're pointing out, has moved to very aggressive levels. I think what people should do, and we talked about this the last couple of months, we're going to lose that. You've been able to sit in cash at 5 1/4 and just sit there. And by the way, the last couple of years, the trade has been sit in cash and NVIDIA, or cash and AI, or cash and tech stocks. That cash is coming down. And so I like the idea of, gosh, lock these yields in, hold the belly of the curve. I think people will be comfortable. You've seen the last couple of days, all of a sudden, it's like, I got to get these yields for a longer period of time. That, to me, is the obvious trade. And that is the one, like, you can still get fixed income and build a portfolio with yields above 6% because the funds rate is 5 3/8. I mean, I think we're going to be a year from now. People are going to say, remember, we got to do that. That's where I think the trade is.
Yeah, I have a bond fund manager writing in, Rick, and he wants to know if the yield curve is really going to go positive and stay that way in the next 36 months. Can the long end stay below 4?
So I'm going to say it's a great question. So I'd say a couple of things. One, I think the curve will steepen. Like I said, I think the front end now is pricing in an awful lot. But I think the curve will steepen. I think that 5-year point is where you've still got some gearing to the Fed cutting rates. The long end of the curve, so if you take and you go back and say, okay, what should the long end of the yield to the long end of the yield curve be? Let's start at the 10-year point. 10-year point, if you got nominal GDP running, let's say we're running 1.5, although we just printed 3. You got 1.5 nominal GDP, you got inflation, let's say it's 2-ish, although we're trending a little bit lower. Listen, I don't think that 10-year is that far off of, should we be 3.5 to 4 in the 10-year? I don't think we're going very far from there. Back end of the yield curve, I don't know why. You don't really need to own it. And my view is, the long end, there's a pension bid, there's a life insurance bid. There's not that many long bonds in circulation after what the Fed owns and pensions own. So, I think people put on the steepener trade, realize there are not that many long bonds. I just think the long end of the curve is like, it's not, like in a portfolio construction today, A, it's not a hedge, and B, like, why do you own it? Just clip all the yield you need in the belly and carry on.
All right, Rick, we're going to hold you over. We want to talk a lot more with you. Rick Rieder of BlackRock is going to stay with us. I want to get a quick check on futures now. We've seen them in the green on the S&P, and we are up on futures 0.1%. So
that's so exciting.
You're more excited about that than Sonali is about the 2-year falling
the 2 basis points
below 365. NASDAQ futures down 0.1%. Russell futures down. Look, they're not moving that much, but as we get closer to the open, maybe we see a little bit more movement after that number that we've been waiting with such extremely bated breath for. This is Bloomberg. All right, quick check on futures here. We're really not seeing a lot of movement. For all the hype behind this non-farm payrolls number this morning, it didn't deliver in terms of market reaction. S&P futures are basically unchanged. I mean, up 0.1%. Now, I'm looking through assets across asset classes for movement. NYMEX crude, I see a little there, so oil up 0.5%. The dollar is doing a whole lot of nothing. The 2-year yield is down 4 basis points.
But 20 basis points on the week.
But 20 basis points on. No, you're right. I mean, it is a 370 handle, a 360 handle is a pretty big surprise there. We are back with Rick Rieder, CIO of Global Fixed Income at BlackRock. Rick, where could we see some real movement here? I mean, especially given the volatility that we are expecting in this period. September is a horrible month, at least for stocks. We're getting close to an election. Where are you braced for some real movement?
So, Matt, I would say one thing that I think has been this weird conundrum. I know Katie and I talked about it last couple of months. Rate volatility is very high. And actually, I mean, you look at, like you were saying, it's not really moving that much. I mean, by the way, it was a historically high rate vol pricing into this number. And then obviously that's melting away. Equity volatility has been really low in terms of what the markets are pricing in the options market. Listen, what should happen? So if you think about the multiple in the equity market today, you're pricing a PE of 24 and change with an economy that's slowing, and you've got an election with uncertain results. It's just been a conundrum why equity volatility is so low and rate volatility is high, given you've got a Fed that's pretty deliberate in what they're doing. I think that equity volatility has been a gift in how cheap it is. I think you'll see gyrate like you've seen. I think you'll see gyrating of the equity market. You look at some of the tech names over the last few days. I know we have Broadcom today. Listen, I mean, to price PE ratio and technology in the mid to high 30s, you got to get earnings growth that is dramatic to get there. So I still think that the equity the volatility of the equity market is where we're going to see, and particularly in tech, is where you're going to see some movement here.
Well, Rick, that's really interesting. Just to crystallize that point, I was going to ask you how those two lines come back together, bond vol and equity vol. It sounds like you don't see bond vol necessarily calming down here. It would be a catch-up of equity volatility.
No. I think it's coming down. Rate vol's coming down a lot now this morning. I think, part of when you think about portfolio construction, things like agency mortgages that, people worry about volatility. I think rate vol's coming down, and I think rate vol will come down. And then, I think equity vol, will, it moves around sporadically. But then you get this period where people feel sanguine about where we're going. And we were doing S&P call spreads when vol was under 9. And, now obviously we've moved up a little bit. It doesn't, that stuff doesn't make a lot of sense. So I think the idea is rate vol will come down. I think equity vol will be erratic, and then you buy it when it comes down.
All right, so there's the playbook there. I want to ask you about where you are on the curve. I know that you've been in the belly for a while. That's been the sweet spot when it comes to the Treasury curve. Are you still there? Are you thinking about extending duration now that we have a much clearer picture of where the Fed is going to go?
No, so we've been front to belly for a long time. And the one thing that I think is, letting some of the front go is, we still are in the front. But, it still carries pretty well. And if you think about where we're going to be, but, do I like letting some of our, this front end position we've had, should we let some of that go? Yeah, I think, and we have. Do you let some of that go? I think so. There is, people are building in a pernicious deceleration of the economy. I think the economy's slowing. I just don't think it's that dramatic. So let a little bit of the front end go. But no, I still like, to me, if you can buy yield, and use a high yield market, use the securitization market. We talk about agency mortgages. Europe, where you look at some of the data in the economy in Europe, and particularly today, slowing. European rates. I still like that. I still like buying these yielding assets and clipping coupon. Like if we can clip, so go back. If the equity market, if return on equity is coming down, let's say in a slowing economy, return on equity is 8 to 10%. If I can buy fixed income and sit in yield at 6.5 or so, that's pretty good. That is pretty good.
Rick, it's interesting. If you look at the movements in the bond market this week, this was really supposed to be the moment of the week after the payrolls data, and you did see a move, but really you saw bigger moves earlier in the week off the heels of other economic data that showed weakness. When you read the path forward and you're looking at the manufacturing data and the services data and the payrolls data, what is going to matter most to you to give you a picture of what this economy looks like and what's slowing down more than others?
That's a great question. So, by the way, I think surveys, I like the hard data. The reason why today's number is so important, it's hard data. I think the surveys, people, say what they think they should do, but they do. What they actually do is more important. So, I love earnings reports. Listen, you've seen some some retailers with some pretty harsh numbers. I've talked a lot about low income. You saw that, it was $1. You saw a bunch of these companies. That to me is real data. And then, you got to focus on what's happening, the consumer, credit card charge-offs, auto loan delinquencies. That to me gives you a pretty good indication of, you got parts of the economy. We've talked about lower income that's struggling a bit. The other thing that I'm going to really focus on, CapEx and R&D spend. You have concern about global trade, what happens with tariffs. Are companies going to start pulling back? Because much of what's buoyed the economy, spend on R&D, spend on AI development, software, that's going to be really big. So how companies articulate, do you wait, do you pause a little bit to get more clarity? Right. That's going to be a big deal to watch.
Rick, we only have a minute left here, but I'm very curious about your thoughts about the political ramifications of what happens in the bond market. We spoke to John Paulson yesterday, who's an informal economic advisor to Donald Trump, who says he will lower interest rates, which of course we know he personally can't do. Only the Fed could do that. Yet Paulson believes we could end next year as low as 2.5%. What do you think of that call?
So I think rates should be lower, and there are a variety of reasons. And I think if some of the motivation for that is because we've got a debt burden in the country that's too high, I think it's right on path in terms of we need to get the rate down. I think, like I said, 5 3/8 funds rate's not the right level. We need to get the rate down. Do I think we're going to go that low? Listen, the data doesn't suggest we need to go that low. I think the terminal funds rate is higher than that. But listen, is the trend, particularly in the front, we talk about the belly of the yield curve, that we get rate lower? We actually have to get it lower because if you look at the debt service on the country, I think a year, 2 years hence, people are going to realize that debt service is a tough dynamic for the economy.
I realize it already. I talk about it every day.
There you go. Rick Rieder, it's always great to speak with you. Really appreciate you taking the time on this busy morning. That is Rick Rieder, of course, of BlackRock. Now, coming up, less than 4 minutes to the opening bell, we'll start the trading day with Greg Boutle of BNP Paribas. That's next. This is Bloomberg.
We are moments away from the start of trading on this hallowed non-farm payrolls day. This is Bloomberg Open Interest. I'm Matt Miller. You can see that futures are really doing a whole lot of nothing, even after a miss on non-farm payrolls. Maybe that's because, bad news wasn't bad enough to spur a 50 basis point rate cut. You can see the New York Stock Exchange here ringing the bell. Down on my over my right shoulder is the NASDAQ, and we're still over 100 points, 170 points basically away from an all-time high. Interesting note from Ned Davis out today saying that the volatility, the drops that we've seen here, we're still in the midst of a correction, but in a bull market. So let's see if any of that plays out today. Let's get over to Katie Greifeld right now. She's got a check on your major averages. Katie?
All right, like you said, a whole lot of nothing, but let me try to sell this. You take a look at the S&P 500 right now. It's up. We haven't seen that in a while. We know it's been an absolutely brutal start to September, to this trading week, but today, a little bit of relief on the S&P 500, up 0.1%. Not quite there yet when it comes to big tech. The Nasdaq 100 down about 0.1%, and small caps actually peeking into the green as well. The Russell 2000 currently up about 0.1%. Let's get over to some individual stocks that we're keeping an eye on. And up first, Broadcom shares down bigly after offering a disappointing sales forecast. Analysts noted that the company's non-AI portions of the business are growing more slowly than anticipated. That is not what traders wanted to hear. Sonali shares currently down about 7%.
Bigly, I want to keep that word in this program, Katie. I'm also keeping an eye on U.S. Steel after the CEO of rival Cleveland-Cliffs said he was absolutely interested in bidding for the company's assets. You now have U.S. Steel up about 2.4%, and Cleveland-Cliffs roughly unchanged this morning. Remember, though, the Biden administration is preparing to block the $14 billion Nippon-U.S. Steel deal, and that Cleveland-Cliffs attitude is a real change in tone, Matt.
All right, Intel is considering options for its really large stake in a company that's gotten a lot smaller, Mobileye, the struggling automatic driving software startup. According to sources, Intel holds actually an 88% stake in Mobileye, which was a massive company, but now it has a market value of only about $10 billion. Let's get a closer look with Abigail Doolittle. Abby, what do you see?
Well, it is a really large stake. It's almost the entire company, as you were mentioning. Intel has an 88% stake in Mobileye. And earlier today in the pre-market, Intel had been higher on this news, the idea that they are considering lessening that stake. There's going to be a board meeting of Mobileye here in New York later this month where it will be discussed. Mobileye down 6.1% off the lows. It's been down somewhere between 2 to 3% to closer to 8% or more on the possibility that Intel could offload this stake. And it's interesting because they offer software and hardware for self-driving automated systems. And because of the pandemic supply gluts, that has really hurt Mobileye. And so this is some of the facts that we were just talking about. In addition, it's interesting because they have a network and edge business, which has suffered big declines. Last year, they saw revenue for their network division fall by about a third. They're considering options there, and they're also considering a split of some of their product design and manufacturing. So Intel, which is down about 60% on the year, in a world of hurt, trying to produce and turn around. Mobileye, you can see here the revenue on a year-over-year basis. The first quarter of this year down almost 50%, and then this third quarter estimate down 8.4%, 16%. Any way you take a look at this, Sonali, it is not good, and this helps to explain why Intel may be considering or is considering unloading some of that stake in Mobileye.
Abigail, we appreciate it. Thank you so very much. We're going to now bring in BNP Paribas U.S. Head of Equity and Derivative Strategy, Greg Boutle. And you look at the S&P 500, and after 3 weeks of gains, you are seeing red on the screen for the S&P 500 this week. Tough way to start September. What does sentiment look like now going forward after we've seen a little bit more of a drawdown?
I think it's really mixed, and you see that looking at the options market relative to the spot market. So coming into today, we had the S&P just below all-time highs, but the VIX in the 20s. I think one of those two things has to give. Either we're in a more Goldilocks environment and that VIX and volatility is going to mean revert, or you're going to see an S&P correction.
Yeah, we were basically at an all-time high on Friday, right? I mean, nearest damn it to it. And we've been down every single day this week. Okay, there was no trading on Monday, but I think into the payrolls number, this market has been so bearish. Why do you think that is if we're getting set up for a rate cut?
So I think when you look at rate cuts historically, you tend to get one of two things. Either a preemptive rate cut that drives great returns for equities. So you could think of 1995, 1998, or 2019. Rate cuts followed by double-digit returns from equities. But you can see the converse where the Fed start cutting, and they're cutting for a reason, that things are slowing. And the start of Fed rate cutting cycles, think 2007 or 2020, have been around some of the deepest, most volatile drawdowns we've seen for equity markets. So really, it's less about...
Those were crazy times, dude. I mean, we're looking at 3% GDP growth and 4% unemployment. Inflation's a pretty mild 2.5%. Things look good.
In the rearview mirror.
Yeah.
So I think the important thing is the trajectory of the data. And we all know that the data is slowing.
Yeah.
And the question is it slowing in a benign fashion in which those Fed rate cuts will be welcome and it will help the equity market? Or is it slowing in a way that it could accelerate? And I don't think the data that we saw today answers us one way or the other.
So what do you do with that? I mean, do you shift to a more defensive stance in your portfolios? When you look at the rear view, obviously tech has been the big winner, even with the last few weeks. Do you sell out of that? What are you doing here?
I think being more defensive is prudent at this time, but the way we do it is via the options market. So when we look towards what we have in the remaining kind of calendar year, next week we have a presidential debate. After that, we have the FOMC, the first rate cut of the cycle, with expiry. A couple of weeks later, earnings season kicks off. You see Broadcom getting stocks moving again this morning. And then you have the election itself. So there's a huge range of potential endpoints this year and a huge range of potential paths to get there. So owning optionality, we think, is the best trade into the back end of the year.
So we were having this debate this morning. We love to do this thing where each of us kind of take a side on something, and then we ask our guests to settle the score. How much does index rebalancing matter to this market heading into that rebalancing rather than coming out?
Especially considering this is a different rebalancing, right? Because Berkshire Hathaway, Buffett, they dumped a ton of Apple shares, which is a gigantic company. It's not the same as like triple witching, right?
Yeah.
I think index rebalancing can matter. It can matter for stocks. It's things that people can trade around. But where we end the year isn't going to be driven by index rebalancing. It's going to be driven by corporate earnings, the election, and the path to macro data.
So did we all win then? I feel like
I feel like you came out on top. Katie said there's like a glitch for 15 minutes.
Here's the market. Is it a trader's market or an investor's one right now, given the volatility that we have?
I think it's a trading market. So you just look at the path of equities over the last 6 weeks, from all-time highs back down to 5,100, back up to touch all-time highs. So there's plenty of opportunities to be nimble and make money, and there's plenty of opportunities to be wrong.
Can I get your take on earnings? I mean, people tell us also that presidential elections, while we love to talk about it and it's sensationalist a lot of times, especially with one of these candidates, it doesn't really matter, right? Earnings is what really matters. And we were up, 11%, 12% on corporate earnings in the last quarter? Sales were up 5.5%. I mean, things look strong. Are they going to finish out the year that way?
Yeah, so valuations are elevated, so I think earnings need to be strong. The question that people will be looking at, again, is that kind of second derivative. It's similar to the macro data. Are things cooling slowly or are things cooling quickly? I would challenge you a little bit in terms of, do elections matter for stocks? If you go back to the 2016 election, small and mid caps, the Russell, IWM, it had 15 consecutive up days around the election. So there is definitely room for rotation, different relative winners and losers based on the outcome of the election.
So how are you playing that potential for rotation? I mean, is that something where you're going actually into the stocks, into the indexes, or are you also taking that options-based approach?
Yeah, so again, I think it's an options-based approach. The real challenge of trading the election now is there's an awful lot of water to come under the bridge in between now and the election date. So you could get the election call right and be very wrong in between. So I spoke just now about the reaction that Russell had to the 2016 election. I think it's probably the most election-sensitive ETF or major index that we would look at, but it's also very sensitive to the macro data. So if we had a further cooling of the macro data, weakness heading into the election, we think the Russell will be very sensitive to that, and we think it will be sensitive to the election outcome. So we think optionality on the Russell is probably one of the best ways to play directional trades, be them bullish or bearish.
Which president is better for the Russell? I mean, is this a situation where you want a president who feels the need to intervene in the rates picture, where somebody wants lower rates? John Paulson told Sonali yesterday 2.5%.
Or one that lowers the tax base for small businesses.
And taxes on realized gains.
Right.
If you have an environment where you have a presidential candidate talking about lowering corporate tax rates and focused on domestic policy, that's something that's going to be good for small and mid caps. We saw the reaction post the 2016 election where the best performing pocket of the market was the small and mid caps. So I think for us, that's the part of the equity market that would be most reactive to that outcome.
Okay, so on that note of lowering tax rates, you have former President Trump telling people that he will lower the corporate tax rate to 15% if you manufacture in America. But if you manufacture in America, does that raise your costs otherwise?
Potentially. But I think the knee-jerk reaction to the market is not necessarily going to be what's legislated. It's what's going to be talked about.
It's the direction, right?
We have that election at the start of November, and the price action through December and January is going to be based on that rhetoric there. So if we're leaning towards helping out domestic U.S. corporates, then something like the small and mid caps is a very domestically orientated index versus something like large cap tech, which is much more multinational and has much lower effective tax rates already.
All right, Greg, it's always great to see you. Really appreciate you taking the time out of a busy morning. Have a great weekend. That is Greg Boutle. He is BNP Paribas U.S. Head of Equity and Derivative Strategy. Now, coming up, the hits keep on coming for Supermicro as it gets a downgrade from JP Morgan. Details next. This is Bloomberg.
This is Bloomberg Open Interest. Quick check on some of the individual stocks trading just minutes after the open, 13 minutes in, 14 minutes into the session. Look at Mobileye there. Down another 9%, hitting a record low today. The report's out that Intel, considering a sale of some of its massive stake in Mobileye. Intel owns 88% of this company, but it's worth less now than $10 billion. So tough time to sell for a company that got in much higher. You're supposed to buy low and sell high. Broadcom down 10% after earnings that didn't miss. The forecast for $14 billion in sales was less than the $14.1 billion in sales that the street was looking for, but that's not, I wouldn't say a huge miss. Nonetheless, a concern about their non-AI business decimating the market cap, and then Nvidia down 1.3%, a smaller drop, but a much bigger company, so will affect the indexes. Katie?
All right, it's time now for our top calls. Some of the analyst action in focus this morning, and first up, JP Morgan says that Supermicro is no longer a buy, downgrading the server company to neutral, slashing its price target nearly in half. The move comes, of course, in the wake of the company's delayed 10K filing. Usually that's not a good sign, and as such, the analyst recommends that investors remain on the sidelines until the company is back in compliance. You can see shares down 4.5%. Next up, Barclays says that Robinhood is no longer a sell, raising the stock to equal weight. The analyst says that the company has matured and sees potential sales catalysts from new products and regulation. Barclays also upgrading Coinbase for the same reasons. And finally, Frontier Communications no longer a sell, according to Wells Fargo. The firm is upgrading the telecom company to equal weight following its deal to be acquired by Verizon. The analyst says that the deal was a, quote, fitting end for Frontier, Sonali.
And coming up, the Fed should cut rates around 3%, maybe 2.5% by the end of next year. That's according to John Paulson. We're going to hear more from our interview with him next in our Wall Street Beat. Stick with us for that conversation next. This is Bloomberg.
This is Bloomberg Open Interest. Let's take a look at the stock market about 18 minutes or so, 28 minutes into the U.S. trading day. You have the S&P 500 actually in the green right now. The NASDAQ 100 not exactly there. It's actually deepening losses because we have those losses in Broadcom, in Tesla, in Nvidia. That is all weighing down on your big tech benchmark. Meanwhile, you take a look at the Russell 2000, your small caps up about 0.3%. It's your winner right now, Sonali, but, you know, the day is young.
The day is young, and it is long indeed. We're going to also talk now about the Federal Reserve, because expected to cut rates in a couple of weeks, of course, and some in the market think they've waited too long. John Paulson spoke to Bloomberg to tell us exactly that.
The immigration policy is a negative for our economy. If you look at New York City, we have hundreds of thousands of immigrants, which are costing the economy valuable resources that existing taxpayers are paying for. So we have to provide health care benefits, housing benefits, food benefits, and these workers aren't allowed to work. So I don't think the illegal immigration has been a benefit to American workers. It increased the supply of cheap labor, which held down wage growth for American citizens.
But wage growth has been part of the inflationary story, has it not?
Wage growth has been grown less than inflation. That's why real wages have declined.
I also want to talk about interest rates, because at the end of the day, there has been a lot of concern on Wall Street about what a Trump administration would mean when it comes to the Federal Reserve. There was, of course, that Wall Street Journal report a number of months ago that questioned whether the Federal Reserve would remain independent. And then we also had the former president commenting in an interview with Bloomberg as well, saying that the president can certainly be talking about interest rates because he has good instincts. That doesn't mean he's calling the shot, but it does mean he should have a right to talk about it like anyone else. Do you share that concern that he could potentially damage the reputation of the Federal Reserve as an independent organization?
No, I don't share that concern. I think it is important for the president and the White House and the Treasury Secretary to comment on economic policy, including interest rate policy. But ultimately, the decision is up to the Fed. But it's important for the Fed to hear other viewpoints and to make sure the Fed policy is in sync with overall fiscal policy.
To that end, what do you believe should happen with interest rate policy through the end of this year?
Well, when you look at inflation now is somewhere around 3%. Interest rates are 5%. So real interest rates are too high. So the Fed, I think, waited too long to bring interest rates down. So I think the likely course of action is going forward is the Fed will start to cut interest rates.
What should they be by the end of 2025?
It's difficult to predict, but my best guesstimate would be around 3%, perhaps 2.5%.
2.5% to 3%. That's where John Paulson thinks rates will end up by the end of the year. Now, time for Wall Street Beat, because former President Donald Trump made his bid to Wall Street and New York's business elite at the Economic Club of New York yesterday. And here is what he promised if he wins in November.
I am promising low taxes, low regulations, low energy costs, low interest rates, secure borders, low crime, and surging incomes for citizens of every race, religion, color, and creed.
Joining us for more on the candidates' economic plans is Bloomberg politics editor Laura Davison in Washington. And this was a really interesting moment right before that debate next week expected between former President Trump and Kamala Harris. But let's talk through first the reaction from Wall Street to that speech yesterday, because there were really mixed emotions, weren't there, Laura?
Yeah, there was really a sort of a difference in tone here from where the president has been. He was going speaking in front of a bunch of business leaders, many of whom are not used to hearing Trump speak. So some are very surprised to hear sort of the proposals he has and sort of the way he talks about it without some of the specifics. But others, there were many Trump allies in the room, like John Paulson, like Scott Bessent, who said, look, this is the plan we need. We need to move forward with very low interest rates, very low taxes. What Trump did not talk about specifically, though, is how he intends to achieve some of those things. The president, cannot lower interest rates. That's the Fed's job. Lowering taxes. He needs Congress to do that. Energy prices, also something the president doesn't have direct control over. So those are the policy details that Wall Street is looking to see kind of how he might go about doing that.
I mean, they all need Congress to play along. And it seems like he laid out a lot more in terms of proposals than the Harris-Walz campaign has laid out. I was also surprised, Laura, by such a warm reception, such a positive reaction by all that were in the hundreds of like the masters of the universe were there, and he got applause at many moments in between. So I thought it was pretty positive reaction.
Yeah, there were about 650 people in the room, which shows that people are not shying away from this event, that they are going. They want to make sure they're there because there is a chance that a very strong chance that he is the next president of the United States. Harris has been gaining on him in the polls, but this is a very, very tight race. And I think business leaders, as they're planning ahead, are looking, that there could be a lot of different outcomes in this race, both at the White House as well as the congressional level. And because 2025 will be such a big tax year in Washington, big swaths of Trump's tax cuts expire, which means that there will be an all-out fight, both from everything from capital gains to the corporate rate, that they want to make sure that they're prepared and positioned for what could happen.
And so set this up in terms of the debate that we're finally going to see next week. Of course, Kamala Harris and Donald Trump facing off. How much substance are we expecting when it comes to some of the economic policy proposals that we're talking about right now?
In short, not a lot. Neither campaign is expected to come to this debate, to have new policy proposals that they're going to roll out during the debate. Instead, what both campaigns are doing is trying to make sure that they come out looking strong, that they land those zingers, that there are, small little moments that can get shared on social media. This is not expected to get into the weeds of, budget policy or any of that. This is more about overarching themes. And this is really sort of a difference from Biden to Harris. If Biden really wanted to campaign on the details, Harris is much more interested in campaigning more on a message and a vibe.
All right, Laura Davison, really appreciate your reporting as always. And of course, Bloomberg Television and Radio will have special coverage of ABC's presidential debate between Vice President Kamala Harris and former President Donald Trump from 8 p.m. to 11 p.m. Eastern on Tuesday, Matt.
All right, we will, most of us will be watching that.
Or asleep.
It's kind of late, right?
It is a little late.
For those of us who have to get in the office early.
We'll be paying attention. That is the catch-all.
I'll stay up and watch it.
Saying you might watch the clips the
I
next
definitely
morning.
am glad I watched the last one.
I'm glad we were both, you were there. I got locked out of the event yesterday.
There were things that caught a lot of us by surprise last time. Coming up the next hour, Tiffany Wilding of PIMCO reacts to the jobs print. Then DraftKings CEO discusses the rise of sports betting as NFL football season begins. And LendingClub CEO prepares for interest rate cuts to impact his business. This is Bloomberg. All right, we are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
Coming up, job jitters. U.S. hiring remained tepid in August as the unemployment rate ticked lower.
The jobs data puts a jumbo Fed cut in play. Traders are pricing in a 50-50 chance of a 50 basis point cut this month. That's exactly what they were doing yesterday at this time.
That's totally right. But speaking of bets, the rise of legal gambling is changing how millions of Americans root for their favorite teams. We'll discuss with DraftKings CEO Jason Robbins as NFL season kicks off. Meanwhile, you take a look at these markets. We're now 30 minutes into the U.S. trading day. I triple checked. You take a look at where we are. Actually, now we're flipping back to red for the S&P 500. Same thing, too. If you take a look at the NASDAQ 100, losses accelerating here. Of course, a lot of your big names are lower right now. You think about that wipeout underway in Broadcom. Certainly not helping here. Tesla, too. Then you take a look at the bond market. You're not going to find a haven there necessarily because 10-year yields now higher on the day. Not by much, but still up 2 basis points when it comes to that 10-year Treasury yield. Meanwhile, of course, when it comes to the labor print that we got at 8:30 this morning, here's what Acting Labor Secretary Julie Su told us last hour in response to that jobs print.
Overall, this is another month of many months in which I've come here and we've talked about how we continue to see job growth, right? The numbers are still up. We're continuing to see growth in various industries. We see construction, healthcare, leisure and hospitality, right? These are all signs of an economy reaching a normal, steady, stable state.
We're going to now discuss this with PIMCO economist Tiffany Wilding. You look at the numbers this morning. There are more and more people out there that think you could see that 50 basis point rate cut in September. Are you one of them?
Yeah, I mean, so when we look at the aggregate data, we think the economy is definitely slowing, but there are indicators that would suggest historically that we've been in recession to us. When we look at a broad array of indicators, we don't think we are. So we think we're still growing, but certainly slowing. And I guess, when we think about September, we think 25 basis points is quite reasonable, given the bar that Chair Powell laid out at the Jackson Hole conference, which is that if you get further deterioration in the unemployment rate, you will see a faster pace of rate cuts. And we didn't get that. We saw the unemployment rate, tick down a little bit this month. So, I think overall, we would argue, maybe they start off with 25, but I think the bigger picture here is that the economy is returning to normal, but monetary policy is still tight. The policy rate is still elevated. And so the Fed, they need to adjust policy back to more normal levels. And the question is just how quick do they want to do that?
What are normal levels?
Yeah, I mean, I think that is one of the key questions, and I think that is why, you try to feel it out along the way. So, the Federal Reserve doesn't want to overnight just reduce rates by, 200 basis points or something closer to where they believe normal is, because they kind of want to go in increments to see how the economy responds, to get information on where normal is along the way. So certainly I think getting there a little bit faster than what they were projecting when they came out with their forecasts in June. I think they'll be a bit more aggressive with their cutting cycle when they talk about it in September. But overall, we still think that the economy here is not consistent with a recession and more aggressive cuts to lower levels.
And you think about what big pieces of data we have left until we get to that September Fed meeting. We have inflation next week, so the party isn't over yet here. And it feels like, of course, the Fed and markets, traders, investors have really shifted their attention from inflation. Now it's just the labor data that we are mono-focused on. Do you think that's the right course of action here? Do you see any risk that inflation could reaccelerate and maybe take us by surprise?
Well, I mean, certainly there's always the risk. Obviously there can be a lot or different range of things that happen. But I think the bigger point to us and why we think there's a focus on the labor market is that post-pandemic, we had labor scarcity. We had very tight labor markets. That was clearly putting upward pressure on wages. If we look at a broad range of labor market data, as I said, it's slowing and it's normalizing. It does not look like a labor market now that is putting upward pressure on wages. And if it's a labor market that's not putting upward pressure on wages, then over time you should expect inflation, to get back to, at least close to target, if not at target levels. So I think that's why you've seen Chair Powell basically say that the distribution of risks around the inflation outlook is no longer to the upside. We are more balanced on that, and if anything, just because historically when you've got negative labor market momentum, it tends to feed off each other, the risks are maybe to the downside. So they have, as a result of that, I think adjusted their view. They probably are going to cut a little bit more aggressively, and I think that's appropriate just given the economy's getting back to normal.
I'm really interested, Tiffany, in the quality of the data that we are getting, because you have the market significantly reacting to various data points throughout the week. You had a 10 basis point move downward in the 2-year yield on Wednesday alone. This morning, you had a significant move on the heels of that job report, but that move has all but erased. You actually have the 2-year currently flat. You still have Fed swaps pricing in more than 110 basis points worth of rate cuts through the end of the year. But it makes me wonder, is it the jobs data that's going to be guiding the market most firmly moving forward? Or do we have to start parsing more economic data more seriously, like manufacturing data and other data points?
Yeah, I mean, I think if you look at the broader range of data on the economy, it supports this view that we're not in recession. We're slowing. If you look at consumption data, credit card spending data that's more real time, retail sales data, it basically suggests that the consumer's doing okay. We're tracking consumption growth for the third quarter to be over 2%. Overall this year, consumption growth has been about 2.5%. That again is an economy and a consumer, that's just doing fine. It's not consistent, with an economy that's in recession. So I think you have to be very careful about the various indicators. All of them are noisy. We had a very large increase in immigration over the last couple of years. That's moderated this year, but the indicators that we look at are not set up to pick up in real time those increases in immigration flows. So I think it's distorting some of the labor market indicators. It's resulted in the rise in the unemployment rate, and it's making things a little bit more difficult to read. And I think that's why you're seeing more market volatility around these various data releases, just because there's more uncertainty, the data is a bit more noisy, and you have to put all the pieces together here.
You were a Treasury market policy analyst at the New York Fed. At the beginning of your career. What do you think about the debt and deficit that seems to get talked about, but no one really worries about it? Nobody has a plan to reduce it, and we're looking at, $100 billion plus in servicing costs every month.
Yeah, well, just from purely kind of from a math perspective, as the Federal Reserve starts to cut interest rates, that should, kind of help ultimately with the deficit outlook. So deficits are sustainable if you have real interest rates that are below real growth rates, right? Because real growth rates, that's all about tax revenues, and the interest costs are on the expenditure side for the government. So, that quote, R less than G is, the government is still under a sustainable debt load right now. But that doesn't change the fact that if you look at the CBO estimates for future deficits, for example, and debt, we are expected over the next 30 years to get to 200% of GDP almost. So at some point, we are going to have policymakers that have to make hard decisions. It doesn't appear that that's going to be, either current presidential candidate is certainly not running on a platform of fiscal austerity. So maybe it doesn't happen in the next 4 years, but at some point it does need to happen. Now, I think the markets are giving the U.S. federal government a lot of long-term credibility for a couple of reasons. One is just the dollar is still the reserve currency of the world. Treasury markets are exceptional because they're the safe asset of the world. But also, if you look versus other countries, other developed market countries, the U.S. actually, the reason why we have larger deficits is we raise less tax revenue. So I think there is room there. If the markets, you had bond vigilantes coming back and the government needed to do something, they could raise revenues by increasing taxes.
Great perspective. Really glad we had you on. Tiffany, thanks so much for joining us. PIMCO economist Tiffany Wilding. Let's get a look now at some of the stocks moving at this hour. For that, we go over to Abigail Doolittle. Abby, what do you got?
Well, let's take a look at the shares of Broadcom, because on the day they are down about 8% or so. This after they actually put up a really strong quarter relative to the AI segment, but it was the other pieces of the puzzle, the other pieces of their revenue pie that were a little bit less. The guide for the fourth quarter coming in short of the analyst expectations. The guide for $14 billion, again, a little bit short in terms of the quarter that was. They beat, but priced to perfection to some degree on the year, not up nearly as much as NVIDIA into this quarter, but up, and investors wanted some form of not just perfection, they wanted the company to be able to match numbers. Let's check out this software company, ticker PATH, Path. And it's interesting, this stock had been up more than 3% earlier. They put up a good quarter. Now it's down about 0.6%. Their full year forecast, they did raise it. There's almost 8% short interest on this stock, so maybe that could be a piece of it. Earlier, maybe the bears getting out, now the bears back in. On the year, this company's really struggled, down about 50%. And then finally, looking forward to next week, Apple's pretty strong, up about 0.8%, at its highs up more than 1%. And of course, we have the big iPhone reveal event, that iPhone 16 event next week. Into that event, we have the stock again, really pretty solid, Sonali.
Abigail, we thank you so very much. And coming up, we're going to switch gears. I'm into football now, and football is actually back. And that's good news for sports fans and Swifties. We're going to be talking about sports betting next with DraftKings CEO Jason Robins. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. Right now, a panel of 3 judges is weighing oral arguments from Donald Trump's attempt to overturn the $83 million jury verdict against him in the E. Jean Carroll defamation suit. Separately, the judge in Trump's hush money case will soon decide whether or not to delay his sentencing scheduled for September 18th. So some legal wrangling for the president after such a nice lunch yesterday. And the Kansas City Chiefs took the first win of the NFL season last night, beating the Baltimore Ravens 27-20. Plenty of eyes on Patrick Mahomes and Travis Kelce, but also Taylor Swift taking the spotlight, watching from the stands in a Canadian tuxedo.
All right, let's stay on sports here. The spread of legal gambling has changed how millions of Americans root for their favorite teams. And the U.S. sports gambling industry has seen more than $220 billion wagered in the 5 years since the Supreme Court essentially legalized what was previously an underground market. Joining us now, I'm pleased to say we have DraftKings CEO Jason Robbins. And I actually do want to ask you about Taylor Swift, but let me start with, of course, the NFL regular season. It's now underway. What visibility do you have on whether the betting handle on pro football will be more robust than what we saw last season?
Well, if Thursday night's any indicator, we're off to a fantastic start. We had big year-over-year growth and a ton of interest in the new player markets, especially the touchdown markets that we were putting out there. We had over 641 pre-match markets. Same thing again tonight. We traded over 1,300 live markets last night. So just more content, more fun stuff to bet on, and a lot of year-over-year growth.
How does it compare with what you're seeing from prior years? If Thursday was any indicator, how do you kind of project out? Especially now, we were kind of talking about it during the commercial break. Clearly, the NFL is hitting new markets. The Packers are playing in Sao Paulo tonight. What does that mean for you?
Well, I think it's fantastic that the NFL is expanding globally. I think it'll be great for interest in the sport. Obviously, we're very focused on the U.S., but I do think the more global interest in the sport is just something where rising tide lifts all ships. And really, I think it's just part of the overall trend we're seeing where more and more people around the world are getting interested in things internationally. You see the same thing in the U.S. where a lot of the betting is occurring on sports being played overseas. So I just think it's more and more of the world being globalized and people being, having more access to things. And NFL's great content, so you put it in front of people and they're going to enjoy it.
Couple of cheeseheads here on set.
2 out of 3. We'll
Sonali
take it.
is a Green Bay Packers fan. I love when
I hear.
I love, Jason, when the U.S. legalizes things that people are doing anyway, in the dark. But I wonder how concerned you are about a rise in gambling problems, people picking or taking money out of retirement accounts, charging up credit cards. I mean, we hear more and more of these stories. It's obviously an addiction for many, many people. How does DraftKings deal with that problem?
Well, I think it's a very important topic you bring up, and one of the major reasons why it does make sense to have a legal regulated market. We have tens of millions of dollars that we're investing in responsible gaming every year. We have almost 100 employees working on it on their own. 100% of their job is responsible gaming. And so, it's something that we're really putting major investment into. And we have a number of different ways that we approach it. We have tools that we give to players where they can set limits for themselves. We have models that we build that help us understand and flag risky behavior. And we have a player protection team that is trained to have targeted conversations with people when those models, set off certain flags. So I think it's a real important part of having a legal regulated market. In an unregulated market, you're going to have no protections of those sorts for consumers, and people will just sort of be left to their own devices. And I think that, in the legal regulated market, not only are those requirements, but they actually become competitive advantages because people want to play in a place that they perceive as doing the right thing by customers and doing it in the right way.
I did see some study or report or article about people actually stopping day trading or cutting back on day trading because now they're trading more on sports. So there's some replacement behavior going on as well. But I actually want to ask you about taxes because, of course, August was a very volatile month for DraftKings shares. You had announced a planned tax surcharge in those higher tax states that would help offset the cost of revenue-based gaming taxes. You ultimately withdrew that plan, but are there other plans along those lines under consideration to help mitigate the effect of those high state gaming taxes?
Well, at the moment, we're really focused on NFL season and listening to what our customers want and how we can put out the best product and do the best job we can to make our customers feel like DraftKings is the place that they want to play. It's something at some point down the line we may revisit, but right now we kind of heard the customer feedback. It was something that didn't get received in a way that we felt made sense for us to pursue. And that's what we're really all about. I think, as a company, really emphasize culturally listening to the customer and following the customer. And so right now, with the start of NFL season, we're 1,000% focused on serving our customers and understanding how they're enjoying and what we can do better to give them the best experience possible.
I want to talk about strategy here as well, Jason, because you have agreed to buy Simple Bet, which looks to place wagers during a live sporting event. What does this mean for DraftKings? How significant is this for you?
Well, I'm very excited about Simple Bet. One, most importantly, we're getting a great team. I really have been so impressed by all the folks there, and the talent is always what makes these types of deals. But we're also getting great technology. They've built an incredible micro betting product and have a ton of other technology that can be useful for building out our live betting offering. So I think between the team and the tech stack they have, this is really going to put us in a position to accelerate our efforts in live betting and hopefully make it something where we're clearly ahead of the competitive field.
The interest of women for football, for example, obviously has soared because maybe in part Taylor Swift is dating Travis Kelce and then goes to games all the time.
I've heard that. And she, of course, was at the game last night, Jason. She was also in the NFL had a little preview of the season ahead. She appeared in that multiple times. So more women are watching the NFL. Are more women betting with DraftKings as a result?
Well, it's hard to say if it's a result. We are certainly seeing a rise in women betting on DraftKings. And, of course, that's been a trend for a few years for us. So, I think there's some tailwind and just general momentum in that direction. I can't, really attribute it to Taylor, but I'm sure it can't hurt. Certainly, I know a lot of people who love her, including me, enjoy talking about it. And it gives me something to talk about with my wife. Maybe I can get her to start making a few bets, too. I haven't gotten my wife to make any bets yet, but I'm working on it.
Well, to that end, about more women betting, a conversation I've been having over the last 24 hours is what media rights would mean for women's sports to take off more. I'm curious about that more largely for you too, Jason. When you see Amazon, for example, entering the sphere in this massive, massive way with the NBA, with podcast rights, how does that change the way that you interact with different platforms, the type of audiences that you grab as the media landscape changes around sports?
Well, first of all, I think the more ways that, and the more companies, media companies and tech companies that are interested in getting eyeballs on sports, that's great for the ecosystem. It starts with having the content out there so people can consume it and having partners that are really motivated to create the best, experience, the best broadcast, the best stream around that content. So really excited to see that. And for us, I think women's sports is a huge growth opportunity. WNBA has been a great story for us. Women's college basketball has been growing like crazy. I think women's sports is going to be one of the great growth stories of the online sports betting industry for the next several years and beyond. And it's not just women betting, though. It's really everybody. Men are betting on women's sports just as much as they're betting on, the men betting on women's sports are actually greater than the women betting on women's sports just because there's more male bettors. So I think what's awesome is to see it's not just women coming onto the platform betting on women's sports. It's really everybody.
Jason, we got to leave it there. We thank you for your time, of course, at the start of a hot NFL season. That is Jason Robins, CEO of DraftKings. This is Bloomberg.
All right, let's get a check on these markets. An hour into the U.S. trading day, we're going to do that with Bloomberg's Abigail Doolittle.
And we're having an interesting day here, Katie, where bad news is bad news for stocks. Take a look at the S&P 500 E-mini futures overnight ahead of that crucial jobs report, really not doing all that much, dipping into it, then going higher after the number was lighter for investors maybe thinking this means that the Fed is getting more of a green light to cut. But now, again, the idea of bad news is bad news. Right now, the S&P 500 down about 4%. 3 to 4% on the week, heading to the worst week since early March. Let's take a look at that week, in fact, from a cross-asset class standpoint. And here is that S&P 500 down 3.4%. You can see the VIX at a 21 handle, the 10-year yield down 20 bips. Now, you can say, yes, of course, that reflects the expectations that the Fed is likely to cut this month, whether it's 25 basis points or 50 basis points. But this is also a haven asset. So when you put together the picture that stocks are having their worst week in months, and bonds are rallying, that is a risk-off picture. And it's driven largely, I would argue, by this strength that we're seeing for the haven yen. The dollar yen this week down 2.4%. That's the worst week since early August when we had the culmination of that piece of the yen carry trade unwind. There may be more. If we take a look at this S&P 500 chart on the year, we are going to see a nice uptrend, but we're also going to see an area of congestion here. And actually, I guess we're not going to be able to take a look at that, but the S&P 500 does look like it is going to be coming in more. What we have here for the Fed, these are the expectations around the September meeting. At one point not so long ago, actually just 2 days ago, or yesterday, I should say, we were closer to the expectation of 2 rate cuts or 50 basis in cuts. And that right now we're at about 35 bips. It's interesting that, Matt, that everybody's talking about these cuts. In my real life, my own life, inflation is still very high. The idea that in this environment the Fed needs to cut, it doesn't entirely make sense to me, but the market seems to want it.
You're not alone, Abigail. I mean, just look at the affordability of homes and cars is out the window. Any trip to the grocery store will tell you that levels are just too high for most people right now. But the question is, how much will the Fed really cut? We've been hearing anecdotally bigger and bigger guesses, right? Howard Marks was out last week or earlier this week, I think, saying not less than 3%.
Right.
There's a story on the Bloomberg today that Citi traders are pricing in 3 50-point cuts in a row. And then you talked to John Paulson yesterday,
who said that he would go as low as 2.5%. His best guesstimate was around 3%. That 3% seems to be a little bit of the money mark here. But, you know, the market has been wrong before.
Right,
in
but
fact,
he could be
consistently.
He could end up being a pretty big deal advisor to the next president of the United States.
He's
to the next president.
Correct.
Unlikely if Kamala Harris wins that John Paulson will be advising her. But let's talk more about a rate cut with a man who really cares. Scott Sanborn joins us. He's the CEO of LendingClub. And Scott, just to set this up, you know, how important is it to your business? Because you got to make loans in high rate environments just as much as in low rate environments. I'm guessing, though, business is better when they're on the way down.
Yeah, that's exactly right. I mean, rates coming down will be great for consumers, and by extension, it's going to be great for our business, because what we do effectively is help people lower the cost of their debt. And so this will be an accelerant to that. You know, one of the issues that we face right now is that, you know, you were just talking about, people are aware that, you know, homes have gone up 30% and car prices have increased 25%. And they see, and when they take out a mortgage and when they take out an auto loan, they see that their rates have increased and they're studying their payments. Our biggest business is helping people refinance out of credit card debt, which has grown, you know, 25% over the last couple of years. And the interest rates, people don't see them. They don't, you know, when you take out a card, when you get your Southwest card, you don't look at, you're going for the miles. You're not looking at what your interest rate is, right? Or your Bloomingdale's card. And then when you're building your debt, you don't see the implications on your monthly payments.
Dude, even even an Amex, I'm looking at my Amex and I have a decent credit, and I'm still seeing like 20 to 25% APRs, like unbelievable if you don't, you know, pay the bill every month.
Yeah, Scott, you know.
That's right. That's average. That's your average card is about 23%. New cards are 25. I have a Bloomingdale's card. I've got like a 785 FICO, and it's a 34% interest rate.
But do those change, right? Because even that 25%, I'm looking at LendingTree data. I know that you probably have your own as well. The APRs are the highest they've seen it since they started tracking the data. Does that move down after moving so high up?
Well, typically credit cards track the prime rate and they track it on a lag. So the Fed moves, cards typically move 2 to 3 months later. The issue is consumers don't actually know that. Half of all consumers don't know the interest rate on their cards. Sounds like some of you did the work. It's really hard to find. They're not forced or required to proactively notify you. So consumers don't know that their rates have gone up. Even the people who say they know their rate, when we ask, okay, did you know they've gone up because it's, the rate environment has shifted, they don't know that either. So they will come down. They'll come down on a lag, but there are some complicating factors, which is the regulatory environment can change how credit card companies are pricing, right? And, some of the recent changes around late fee rules are looking like they're going to drive APRs up. So that could actually counterbalance a shift downward in the rate environment.
I'm looking at, if I look at your stock against, the banks, it's underperformed over the last 5 years. I'm guessing because they're, much more diversified businesses. Can you diversify your business more?
Absolutely. So, the first, our entry wedge for consumers is for the half of all Americans who haven't paid off their credit card debt, you have a loan. We've got a better one for you. It takes less than 2 minutes. We're going to save you in this environment. We're saving you like 600 basis points off of your credit card rate. Your FICO score goes up. You'll be debt free in 3 years. Our goal is to take that very, very satisfied customer and do more for them. Over 80% of our customers say they want to do more with us. We are now a bank ourselves. We acquired a bank about 3 years ago. So we offer banking services. We also have an auto refinance business. Auto loans, the cost of an auto loan has gone up about 55%. So our ability to do the same thing, which is, hey, keep driving your same car, pay it off in the same time frame, we can lower your rate. So over time, we plan to acquire these customers and then help them save across other areas of their credit.
I believe your high yield savings account right now is at about 5.3% APY. How much does that go down as rates start to subside?
Yeah, now we would expect, look, we're a fully digital bank, and our whole brand mission is about turning banking on its head, right? Traditionally in banking, you selected your bank based on the location of the bank branch. You went there and you never went anywhere else. And what that resulted in is, as a loyal customer to a bank, you are factually getting paid less on your deposits and you are being charged more for your credit. We want to turn that on its head and basically say, hey, the more you do with us, the better it is for us, and we're going to make it better for you, right? We're going to give the advantage to our members. So we would anticipate to always be sort of near the top of the market and for the rates we charge, the rates we pay for our savings account, and be towards the bottom of the market for what we charge on credit. And we can do that because digitally native, highly automated, close to 80% of our loans are auto decisioned as an example. So our rates will move down. They'll move down on a lag, but we would anticipate continuing to be at the top of the market. And, another difference for us is we're still growing, right? We are continuing to grow our balance sheet, continuing to grow our loan volume. So we're going to need those deposits, and we're happy to pay for them.
Scott, with that growth, do you continue to keep clients in the same quality level in terms of FICO scores? And what's the fluctuation of your applicants look like right now in terms of FICO scores? Because we hear so much about a weak consumer. Is the average applicant FICO score falling?
Yeah, so no. What we've seen, so one of the things you saw coming out of COVID was credit scores got warped. Right? People delevered, they paid down their debt. They couldn't spend, right? You couldn't go to restaurants, you weren't traveling, you weren't buying new clothes to go to the office because you weren't going to the office. People delevered. It sort of artificially, temporarily spiked FICO scores, and lenders who weren't in front of it really got burned, and consumers got access to credit they maybe shouldn't have. And so that's why you saw weakness in, a lot of categories, auto, credit cards, and personal loans.
Scott.
Yeah, go ahead.
I want to switch gears for a second here because there's another thing happening in the card industry that I think is really important here, and it's this probe by the United States on reward programs, loyalty programs being offered through the major airlines here. Reward programs are a really common practice in the card industry. I'm wondering what you think about this probe and how it might change behaviors in the lending industry.
Yeah, I mean, all of these regulatory actions have reactions somewhere in the system. What I will say is the card margins aren't going to go down. They're going to figure out a way to get it back. I mean, we saw that when Dodd-Frank was passed with a bunch of restrictions on cards. What happened? Average card APRs went up. We're seeing the same thing with the late fee rules. Where there's a kind of a direction to bring late fees down to $8. And so what's happening? Coupons are going up. So, the degree to which this is the right priority for the regulators, I can't judge. But what I can tell you is they're going to figure out a way, and they being the credit card operators are going to figure out a way to make it back somehow.
They're going to get them money?
Yeah, they have.
I don't know why I did that accent.
No matter what.
Scott, thanks so much for joining us. LendingClub CEO Scott Sanborn giving it to us straight. I really appreciate that. Coming up, not everyone is cashing in on the AI gold rush. Former IBM CEO Sam Palmisano says Intel is now behind the trend. This is Bloomberg.
All right, it's time now for our Wall Street Week conversation. And former IBM chair and CEO Sam Palmisano sat down with Wall Street Week host David Weston to talk about Intel's financial woes and how the once mighty chip company is now behind the technology 8-ball.
If you think back in time, you mentioned the point they were the leaders. When they had an integrated business, I mean, design and fabrication or manufacturing, R&D, manufacturing, design, they controlled their IP. And the thing was called the x86 architecture, which is really the PC client-server era. And in collaboration with Microsoft, they drove the innovation cycles. Those guys led and drove. Well, it's no longer the case now. Intel is behind in the technology. They're no longer driving the innovation cycles. And the bringing back the fabricators or the production side of the company is very, very capital intensive, and it requires large amounts as well as patient capital, which, as you know, on Wall Street Week, most of our investors today in the public markets aren't really keen on the strategy of patient capital.
So what are the prospects of Pat Gelsinger, who came back to Intel, had a grand plan to rebuild the original great Intel? What are the prospects of really being able to do the design as well as the manufacture the way it once did?
Well, I just think, it's plausible. The problem associated is the industry has shifted. And you have focused companies like ARM who are focused on design, who are very, very advanced and do a lot of the work for companies as is Qualcomm and those kinds of folks. And at the same time, you have massive capacity in the fabrication or the production side of the house with TSMC and Samsung and the others. So if you think about it, you need basically very deep technical R&D skills on the design side. And you quite honestly need great skills as far as production, moving down what they call the nanometer curve to this stuff which really is subatomic at this point in time. And that requires massive capital. One tool alone is over $100 million from ASML. So you can imagine the expense associated with doing both of these at the same time. So it's hard technically. It's also difficult operationally. And I think in many ways that the skill set that was required at one point in time to run an integrated business has now changed because people now see opportunities both either in design or in manufacturing or production.
Now, the U.S. government has thought it could perhaps prime the pump here a bit with the CHIPS and Science Act. Among other things, Intel stands to benefit something to the tune of $8.5 billion in various forms of financing. As you say, that's not enough to get you there, but how much of a help is that to sort of get you headed in the right direction?
Well, you remember you have the U.S. and you also have the EU. Both are providing funds, investment funds to Intel. So it is a large amount of money. But to move a fab or build a fab, we're talking about somewhere between $10 to $15 billion today. So, I mean, it's good to have a partnership in the capital model. Needless to say, it would true up the balance sheet of any company, even one as large as Intel. But fundamentally, it'll add capacity, but I don't know if it's going to have enough capacity to differentiate Intel versus the large fabricators that exist already today. So therefore, I mean, they serve, I think, a strategic purpose for the U.S. around national security, which is securing the supply chain of these key important technologies around chips. And today it's the graphics chips, not only the traditional chips of the past. That's very, very important. But the question is, how much of that capacity can one company really provide to the U.S. government?
So Intel clearly has some questions in front of it. Does the U.S. government as well? As you know, industrial policy, so-called, is somewhat controversial in the United States. It's not clear that it always works. There are some examples, like the space program, for example, where it did work. There are some other examples where it didn't work in the United States. Does this tell us anything more broadly about industrial policy?
Well, David, I think it does, in the sense that in some areas it does work. Actually, space is very complicated technically. So therefore, that is where a partnership was formed. But the partnership was a tight partnership. I go back to the early days when IBM was involved with Apollo 13 and the shuttle and all those missions. I mean, there was a very tight relationship between the private sector, the academia, and the research associated with this, as well as the government itself, i.e. NASA. So therefore, for government to really, I think, to create policy and then to execute those strategies, it's extremely complex in the environment where we have so many constituencies and so many parties that are involved. I mean, it isn't just the U.S. that struggled with doing complex technology, industrial policy. Look at Japan, look at China. China's had similar issues with semiconductors. Japan in the past, it was memory, which is, again, semiconductors, where they struggle with this as well. So it's the nature of government itself and how they approach the model. I do think this space program is a good analogy, and there are other analogies where it's worked, quite honestly. The internet is another one of those things, where it's a combination of the research and academia, also the collaboration of the companies at that point in time, and therefore DARPA being the agency, as you know, within the Defense Department around innovation, that also helped and led many of those initiatives that led to the standardization back in the 70s for the internet.
And that, of course, was former IBM CEO Sam Palmisano speaking with Bloomberg Wall Street Week host David Weston. And tune into Wall Street Week tonight at 6 p.m. New York time. Meanwhile, let's get a check on these markets as we hang out near session lows. The S&P 500 on track for its worst week since March 2023. You can see currently down about 1.3%, down 2.2% on the NASDAQ 100. What's not helping matters is you have NVIDIA now at session lows down about 4%. We're going to continue to keep an eye on these markets. This is Bloomberg. The new, in with the old. That's the idea behind Rob Arnott's first exchange-traded fund. The Research Affiliates founder is launching an ETF that will buy the companies that were recently deleted from major indexes. We spoke to him earlier this week on ETF IQ.
This is just a really neat niche idea that we wanted to bring to market. So I had to wait 70 years to partner with ETF architects to launch an ETF based on deletions. What could be better than buying the rejects?
And guys, I have to say, I so enjoyed that conversation. The fund launches next week, and it's really innovative.
He is the smart beta guy, right?
Yeah, the godfather.
Exactly. So now he wants to take the losers, right?
So I love what else he said to you. He said some could still go on to achieve great failure.
Exactly.
And at the end of the day, this is happening. These are being kicked out of the indexes, these stocks, for good reason, isn't it? Why would he buy them then?
That's the thing. And I mean, I loved that point he made. Like, okay, yeah, not everyone's going to be a winner. But if you're kicked out of an index, your expectations are already so low. The bar is so low that the jump to outperformance, it's maybe not as high as if you were already in an index. index. It's sort of like the fallen angels credit strategy, but in the equity market.
You're kicked out a lot of times because your stock has simply fallen.
Right, like
to
I've
a low
gotten
level.
kicked out of a good party, but I'm not horrible. But you know,
You do want to buy low. That's part of the whole plan, right?
How does this tie into what BlackRock is doing? Is this a lot of money managers looking for value at this point?
Right, yeah. So this is sort of a very deep value play. You have to have a strong stomach to want to really play in this part of the market. So it's similar. I mean, BlackRock is definitely tilting more towards value. If you take a look at their most recent model rebalance investment outlook there, I will say it is part of a broader trend that you do have a lot of these big name money managers launching in the ETF wrapper. You think about Rick Rieder. We spoke to him just recently.
Scott
he has an ETF. Scott Bessent filed for an ETF. Nouriel Roubini filed for an ETF. So it's interesting. This star fund manager era is coming to the ETF industry. And a lot of people still have this perception that ETFs are passive index tracking vehicles, but it's changing.
I have a controversial question about this. You know, you have these money managers where fundraising is pretty tough. Are they now going to retail money in order to fill that gap? Is this kind of, you know, the day trader holding the bag?
That's kind of, well, it's a good question. The ETF wrapper, it's really sink or swim. You have to have a great ground game. ETFs, it's often said in the industry that they're sold, they're not bought. You really have to have great distribution, which is part of the reason why BlackRock is so mighty there. But at the end of the day, I mean, it's going to the ETF wrapper isn't going to fix your problems. If people don't want to buy your mutual funds, if they're not interested in your hedge fund, you have to have their performance as well. And we see that time and time again. So we'll see how this ETF from Rob Arnott fares, but definitely a cool idea. And of course, tune into ETF IQ every Monday at 12 p.m. Eastern.
I used to be on that show.
You did.
Remember?
You were deleted
I was
from
violently
that index.
ejected
He
from
was
that
booted.
desk. Let's get a check on the markets really right now, because we are seeing drops of 1.5% on the S&P 500, almost 2.5% on the NASDAQ, and this could shape up to be the worst weekly drop that we've seen for the benchmark indexes in a year and a half. So this jobs number this morning that looked not a bother at first turns out to be a big deal.